Fixed income portfolio management I'm going to discuss now. First of all, for a fixed income we should have benchmarked. Connecting benchmarks to objective and performance of evaluation is the most important part when we are going to do the fixed income portfolio management. We have to see what is our liability structure. So we can see the objective to generate sufficient value to meet our liability. We should also take care of bond index, that what is objective to replicate or outperform an index after subtracting the fee. It's very important that we should know that how to manage a bond marketing index. So it will be on the concept of full replication, means pure bond indexing has to be observed. We can have enhanced indexing that is based on sampling with matched primary risk factors. We can have sampling with minor mismatches of primary risk factors. This is another situation. It can be an active management by larger mismatches, and it can be an active management with full-blown active management. In terms of, let's discuss one by one the full replication. There are certain advantages and there is certain disadvantages. Disadvantage is easy to understand, it's costly, it's difficult to implement, plus it has lower expected return than the index. In terms of advantages, if you see zero or very low tracking errors, same risk factor exposures as index, so it's like connected, low advisory and administrative fee. This is the advantages for the full replications. We can work on enhanced indexing. This is the advantages. It's again less costly to implement, increase expected returns, maintain exposure to the industry primary risk factors. On the other hand, disadvantages: increased ongoing management fee, lower abilities to track the index, and lower expected return than the index. These are the possible disadvantages of enhanced indexes. In terms of enhanced indexes, in the case of minor mismatches of primary risk factors, there are certain advantages, like we can use same duration as index. It can be increased expected return, reduce manager restrictions. On the other hand, it has disadvantages like increased risk, increased tracking errors. We can have increased management fees. These are the disadvantages. Let's discuss active management by having a large mismatches. The advantage is ability to tune the portfolio duration. We can adjust it as per our requirements, increase expected returns, reduce manager restrictions. On the other hand, we have increased risk, increased tracking errors. This is disadvantage, of course, increased management fee if we choose for this option. In terms of active market, full-blown active, the advantage is increase expected return, because you are actively managing and you are full-blown. You can expect increase in the expected returns, and fewer if any manager restriction, no limits on duration. It's flexible. In terms of disadvantage, when you are going fast active, it is having more risk, increased tracking errors, and increase the management fee in general. Let's talk about bond indexes. What is bond market is already we have discussed in certain levels. Now straight away we are discussing what are the factors affecting the bonds indexing, in terms of pricing, transaction cost, in terms of expenses, or a size of portfolio. Factor that affect, of course, enhanced indexing is the selective securities, and of course it's costly to monitor. In terms of enhanced strategies, the first strategy that we can use is cell matching, that is place index securities into a matrix based on risk factor. This matrix is covering from different angles and giving a clear picture. Choose the best securities in each cell. maintain sell weights in the portfolio according to their weightage. Tracking errors, minimization efforts we can do by optimizing with multi-factor models. We have to see, we can constrain it to minimize the tracking errors in terms of bond indexing. Benchmarking is really difficult. Selecting a best benchmark is always a problem because benchmarking should be based on certain matching things and backgrounds. So the basic idea to select the criteria behind the benchmarking is the portfolio along many risk factors. Maybe risk is one of the factors. That's the only way to accurately compare the performance in an actively managed portfolio to a passively managed portfolio. What is active, passive? This is already we have discussed in the other portions. There are 4 risk factor exposure. The first risk is market risk, which is the sensitivity of the value of an asset or liability to change in the interest rates. Income risk is uncertain in terms of payment received or paid. Credit risk is the risk in the bond in terms of portfolio could default. It's like a default risk. Liability framework risk is mismatches in the risk exposure of the assets and liability that could make their values move in suboptimal way. These are the 4 kind of risks. What could be the method to align risk exposure? Of course, we cannot mitigate or eliminate the risk, so there should be some factors to control or model this risk. Maybe some matching stratified sampling can be used. We can use the multi-factor models. We can use the duration concept. We can have key rate durations. We can have PV distribution of the present value, distribution of the cash flows. One by one, I'm going to discuss all these techniques. The first technique is cell matching, that is ACA stratified sampling. We can use the multi-factor model that is benchmarked on a mathematical model taking care of the risk factors. In terms of matching duration of your asset or liability related to your indexing, effective duration with convexity adjustments give an estimated change in price associated with a small parallel shift in the yield curve. It does not account for non-parallel shifts. Therefore, using only duration or convexity is not a full way of thinking it. It will be like inadequate, we can say. In terms of key rate durations, the main problem is the most yield curve shifts are non-parallel. They don't move parallel with each other. But we could have certain solutions for it, that is use key rate durations. These are sensitivity to changes in interest rates associated with key maturities. And we can have measured impact on we can measure the impact of non-parallel shifts in general. In terms of PV distribution of the cash flows, duration is really important. It contributes per time period over the portfolio. Say like 6 months period, we are spreading over, as we know that bonds are serial bond, term bonds, depend upon the situation. Market value of cash flow is in the period divided by the total portfolio or the benchmark. Market value is the weight for that time period. And of course the goal is matching portfolio and benchmarking PVDs in general. What could be the other factor? Of course, sector and quality percentages, sector duration contributions, quality separate duration contributions, sector coupons, maturity sell weights, and issuer exposure. These are the various other risk factors that we should consider. Now, before you trade, what you should know. First is, of course, total return analysis, take into account potential capital gain or losses, not just the yield, so only not focus on the outcome, see the capital gain or losses. Total return analysis allow us to determine the potential performance. We can do scenario analysis, this is very common nowadays. Allows a portfolio manager to ascertain the impact on portfolio total returns under a varying set of assumptions and situations that we can have in terms of analysis. When you are going to analyze, there are certain steps you have to follow. First is, of course, compute your horizon price of bond, then compute end of the period value of accumulated reinvested coupon income, and the step 3 is compute semi-annual total returns. In terms of expected semi-annual returns, yield curve, of course, is not expected to change. The expected horizon price may change.